During the fourth quarter of 2016, which is the focus of this release, we saw an increase in housing prices, general increase in housing prices by 1.58%. When you compare to the 2.2% that we saw in the third quarter, this is a reduction in the rate of increase. The general price increase is on upward trend, but the rate of increase is what has come down. So that is basically the first message. The second is that over the period, and this links to the question that was asked about the performance and the trend over the period, we've seen the house prices consistently being on a positive trend, meaning from one quarter to another, we are seeing the house prices increase. It's the rate of increase that differ from one quarter to another, depending on what circumstances prevail on any given quarter. And that is why we said that in line with the decline in credit over the year from a rate of 16.8% in January to around 5% in August when the law came into effect, to 4.3% in December. The housing market is part of the credit market. And therefore, whereas you may not link the amendment of the Banking Act to this decline in credit, it has an implication because there was a tendency for people not to commit on a long-term basis. That's from the demand side, the consumer side. And the banks were now readjusting themselves into the new dispensation of capped interest rates.
If you look at the statistics you have, and this morning you were sharing that data with at another forum in terms of the credit growth. If you look at the January statistic, then the August statistics, and then the December statistics, you can see clearly the growth of credit is slowing down. Part of it may be attributable to the legislative environment where the Banking Act was amended, but I think that is just possibly a contributory factor. There could be other factors because already the slowdown in terms of credit growth was already being felt even at the beginning of the year in 2016 before the law came into place. But I think the law coming into place may have just given it some additional push. Now, and obviously, the fact that there's a slowdown in credit growth, it affects all sectors, but more so, some specific sectors will be affected more than others, especially those sectors that initially, in fact, the law was meant to have been supporting, and that's especially the SME sector, the new borrowers, the ones who are approaching the credit market for the first time. They don't have a track record. They are not part of the credit information sharing mechanism, and so they are trying to build a credit profile from scratch.